Hello friends, welcome to CEC Live Lectures. Dear friends, with our ongoing series on financial accounting, in a previous session we discussed on journalizing in detail, and today also we would be covering most part of journalizing. Friends, we would be talking on compound entry, opening entry and closing entry in today's lecture, and for this discussion we have with us in our studios Dr. Amarjeet Kaur. Dr. Amarjeet Kaur is a professor of accounting and she is teaching in one of the leading management schools of the country. Friends, she is a certified management accountant from USA and has authored numerous books. A number of articles have been published in reputed journals too. A number of students have pursued their PhD under her able guidance. If you want to ask questions from Dr. Amarjeet Kaur on today's topic, then do call us through our toll-free number. Our number is 1800-110-430. I repeat, our number is 1800-110-430. All dear friends are requested to call in the last 10 minutes of the lecture. Now, I would like to request Dr. Amarjeet Kaur to carry forward the lecture and explain us in detail the other components of journalizing which we haven't covered so far. Hello ma'am, welcome to the lecture.
Hello Kritika. Very good morning viewers and welcome back. At the outset, I would like to wish you all a very happy new year 2018. And now let's begin with the generalizing part, the remaining part of generalizing. Generalizing, as we all know, which we learned in the lecture number 7 in this series, that when we record transaction for the first time in the journal proper, that is generalizing. Basically, recording business transactions in the books of accounts is generalizing, right? We discussed about rules of generalizing. We discussed about debit and credit rule, normal balance rule, and all in the last lecture. Today we will be talking about what is composite entry or compound entry, what is opening and closing entry. So compound, opening and closing entries is the agenda for today. So we learned how to record for those transactions where only one part of transaction is debited and another part is credited. It means only one account having debit balance affected and only one account having credit balance being affected in a transaction. Such transactions were taken. Now, in reality, there are situations when we come across a transaction where more than one account needed to be debited and more than one account needed to be credited. It's not mandatory that all the transactions may have all the composite entry may not have more than one debits or more than one credits. It means one transactions which would be considered as composite or compound entry may have only one debit but more than one credit, and vice versa. It means it may have one credit and more than one debit. It may also have more than one debits as well as more than one credit. I will give you example of almost every situation, but this is important for the purpose of discussion, that you understand the concept. You understand what is composite. Composite means a transaction comprising more than one element, a compound, right? So, we are going to record the effect of more than one debit or one credit in one single entry. So, the question comes in, under which situation we can do so? We can actually pass a journal entry under composite head or composite feature if the same transaction has happened pertaining to accounts but on the same day in one go. So if we have one single transaction which is affecting more than debit and credit sides of different accounts, only then it will be recorded in the form of composite. We have similar thing happening in a day but at a different point of times, because we record in journals on chronological order. We record on the basis of time, on the basis of period, right? So it becomes very imperative to understand that composite entry cannot be passed just because all the transactions have happened in the same day. No. they must happen at the same time, and some part is common, can be generalized. Only then a composite entry can be passed, right? So this is what the other name of composite entry is compound entry. So you may come across any terminology, so don't get confused. Now let's understand this concept with the help of certain practical questions or examples. So now I'm going to take up few examples. Let's have the first example here in front of you, which says equipment costing 10,000 was purchased for 2,000 in cash and signing a note payable for 8,000, right? So what is happening? This transaction is there where three different elements are affected, three different accounts types are affected. So first of all, equipment is affected, right? We are purchasing, so it is coming in. Some equipment is our PPE, the property, plant and equipment is rising up. So one part of this transaction is equipment. The other part, which pertains to the first part itself, has another two parts that we have been paying in cash 2,000, as well as we are promising to pay in future by issuing a note payable for 8,000. So the total transaction was for 10,000, which is going to be materialized or responded in two different means of payments, one in cash, another is by issuing notes payable. So they become your creditors. So we did not pay 10,000 at the time of purchase. Okay. So since the equipment is an asset, we will follow the same rule of debit and credit which we followed last time. So for analyzing, the equipment is an asset, and assets have normal balance as debit balance, right? So we should be debiting the equipment. So equipment has been debit. If you look at the solution part which says journal, and in the debit side I am just putting my cursor here so that you could have a look at. So it's indicating that 10,000 has been debited, right? Now I have the option to debit the equipment only for 2,000 separately and 8,000 separately. I can actually record this transaction in two parts, in two different entries, or I can combine it in one single entry. If I put them in separately, then it would be same as we did in the last lecture. But if we decide to put the two parts, 2,000 and 8,000 together in one journal entry, because they pertain to the same transaction, right? And this particular transaction qualifies to be called as composite entry or compound entry. So the second option is we can credit cash as well as notes payable in this one single entry, and that would be known as composite or compound entry. Okay, so in this, why I am calling, just to recall, why I am calling this entry as composite or compound, because I am debiting equipment and I am crediting two things. So there are two items which are credited. We have two different accounts which are credited. One is cash, another is notes payable. Why cash? Cash is an asset, and the normal balance of an asset, if you recall from the last lecture, is debit. To reduce the balance, debit, the normal balance means to record the increase, right? To record the decrease in cash, because cash is going out, we paid for it. Right? We bought equipment and we paid cash. So when cash is going out, 2,000 is going down, so we need to credit, because normal balance is debit, and opposite of the normal balance would be reduction in the balance of cash. So that would be credited. Or other way around, you want to apply the other rule, debit what comes in and credit what goes out. Under that condition, the equipment is coming in. So we'll say equipment debited and cash is going out, and we can do cash credit, right? Both are assets. So this would be the rule of assets, and assets rule says debit what comes in, credit what goes out. Okay, so this is how you can analyze the transaction by applying either of the rule which you are comfortable with, either the normal balance rule, which is the latest trend, or you can also apply the rule of debit and credit, whichever rule you are comfortable with. The second part to be credited was notes payable. Again, the notes payable are liabilities, and liabilities have normal balance as credit, which means to increase a liability in our book, we should be crediting the item. So my liability is going up, so I need to credit it again. Had it been going down, it would have been debited, other way around. So since the liabilities have normal balance of credit, I shall be crediting this notes payable, right? So that's why this notes payable has been credited. The complete entry would be as equipment debited, cash credited, and notes payable credited, right? And I would call it as a good example of composite entry. Okay, so let's move further and understand composite entries with the help of a few more examples. So let's read this second example, which says machinery costing 8,000 was sold for 20,000 in cash and signing a note receivable for 60,000. Okay, so machinery costing 80,000 was sold. So what is happening here? We need to analyze this transaction. Machinery was sold for 20,000. So what is coming in? Cash is coming in. 20,000 cash has been received. And second part is by signing a note receivable for the remainder amount of 60,000. So cash is coming in 20,000. A promise by someone else to whom you sold the machinery of 60,000 is coming in, and what is going out is your machinery. So we can analyze this transaction again with the help of debit and credit rule and normal balance rule. So let's analyze it. So as per the debit and credit rule, we have machinery account which is affected, and now the machinery being sold means machinery is going out of the business. So debit what comes in, credit what goes out. In the last example, equipment was coming in, that's why it was debited. I purposefully chose an entry where now something is going out, some part of PP is going out. So here the equipment, the machinery is going out. So I need to credit the machinery by applying the rule of debit and credit. Credit what goes out. Okay. Other way around, if I want to apply the rule of normal balance, then how would you look at this transaction? You would basically, what will happen in the normal balance? Assets have debit balance, and normal balance means to increase the asset, right? So, but here the asset is going down, decreasing from my business records. Okay, so I need to credit it. That's why this normal balance rule would credit machinery. So I have discussed from both perspective, debit and credit rule perspective or normal balance rule perspective, that why machinery would be credited, right? What should be debited? What is coming in? Cash. So debit what comes in? Cash is coming in, and another asset, accounts receivables are coming in. So cash and accounts receivable being assets, they both would be debited by following the rule of debit and credit. Now by following the rule of normal balance, why cash would be debited? The normal balance rule says that assets have debit balance, right? And cash is a good example of asset. So cash would be certainly debited because it's going up. And so is your accounts receivable. Accounts receivables are another good example of current assets, and since they are increasing, they are going up in the books, so they should be debited, because normal balance says assets have debit balance as a normal balance, means to increase, to record an increase, we should be debiting it. Since my receivables are going up, So I need to record an increase in my books of accounts, right? So that's how cash as well as accounts receivables are debited, and the machinery which is going out of the books is going to be credited. So this was another good example of compound or composite entry, because here it was inverse of the first entry. The first entry I exhibited in front of you was where our equipment was equipment was purchased, it was coming in. Here the machinery has been sold out. So exactly the inverse is happening in the second example. So just to help you understand both why debit and credit, and another example, another point was that more than one account is debited in this transaction, whereas in the last one more than one account was credited, right? So this actually kind of supports my discussion that a composite entry is the one where more than one account is either debited or credited. And I have put in front of you both the example. We will take one example where more than one account is debited as well as more than one account is credited. It means debit and credit both have more than one item. So we will look at that example as well in the future, in the further discussion. So let's take one more example here. It says payment of 9,200 was made to Ram and he allowed us a discount of rupees 800. Alright, so kindly note down this example. We are saying the payment of 9,200 was made to Ram and he allowed us after the discount of 800. So it means I as a business owe Ram 10,000, right? First of all, we need to be clear, because if I'm actually paying 9,200, my actual due amount was more than that. After discount, my payment is 9,200 and discount is 800. It means 9,200 plus 800 becomes out to be 10,000. So I know I owe Ram 10,000. So now Ram is receiver. So let's analyze this from the both perspective, debit and credit rule as well as normal rule. So debit and credit rule says debit the receiver, because Ram is a person. So here the rule of personal account would be applied. Ram being a person and he is receiving 10,000 from you, so the debit the receiver, so Ram would be debited. Alright, and what will be credited? Why cash? Because cash is going out. So you paid him 9,200 and cash is an asset, and the asset account rule says the type of assets, the first real account, the rule says debit what comes in, credit what goes out. Since cash is going out, so we should be crediting it. Very, very simple. And the third part in this transaction is discount. Discount received is a revenue. Discount allowed is an expense. So expenses have debit balance like assets, and revenues have credit balance. Since this is a discount being received, you paid less than what you owe. You owe 10,000 and you are paying 9,200, right? So you have 800 of discount being received. So this becomes a revenue. So revenue and gains, this become gains for the business, not revenue. So gains and revenues are to be credited. They have credit balance as per the rule of debit and credit, and expenses have debit balance, right? So following the rule, this discount received would be credited because it is a gain to the business. Okay, so that's how we are analyzing with the help of debit and credit rule. Now the same thing, if you look at, can be analyzed with the help of normal balance rule. The normal balance rule, as we know, says that the assets have debit balance. To increase an asset, we should be debiting it, right? So, and to record a decrease in asset, we should be crediting it. So cash was an example. Cash was an asset, right? So cash is an asset for the business and it's going down. To record decrease in an asset, we should be crediting it. That's what the rule says. That is from the normal balance rule perspective. The other rule says, the normal balance rule says, expenses have which balance? Normal balance as debit, and revenues have normal balance rule as credit normal balance. So we are going to credit discount because revenue and gains have normal balance of credit. So it's increasing, the gain is increasing, so we should be recording it in the credit side. Why did RAM being debited? RAM is a liability, and liabilities, RAM was a liability in our books, and liabilities have credit balance as a normal rule, right? And RAM would be debited. Why? Because my liability is going down. The moment I pay him, what I actually owed him till this date, the moment I decided to pay him, I am going to reduce this liability from my books of accounts. So RAM would be debited by 10,000. Alright, so that is from the normal balance perspective. I am purposefully doing all the transactions from both the perspectives so that whichever you are comfortable with, or you can learn both, your choice, a matter of choice of course, or either following either of the rule. So it's your choice. Now let's take another example here. Exchanged old car of book value 82,000 with the new one by paying 3,18,000 in cash. So I got a car which means it has a worth of 4 lakhs. I paid 318,000 in cash, and I gave my old car which was having a book value of 82,000. Alright. So a car is both the example coming in or going out in both the ways. The car is a real thing. A car is a property for the business, PPE. It's an asset. So part of PPE only, property, plant and equipment. So a car is coming in the business, is going up, as well as car is going out. So the debit rule says, debit and credit rule says, debit what comes in for the real thing and credit what goes out. So if we follow that rule, new car is coming in, it would be debited. Old car is going out, it would be credited. You can name the new car, any model, any make you want to, you can assume it. And an old car, you can assume, I purposefully did not name any company or brand. So you can credit the car by the name, by the model itself, which is going out. So both way, one car is coming in, another car is going out. So the rule of real account is debit what comes in, credit what goes out. Since new car is coming in, it would be debited. Since old car is going out, it would be credited. So 82,000 is clear, and it's a good example of composite entry. Because all the three parts of the transaction, they pertain to one transaction itself on one date. And how about this 3,18,000? You paid in cash, and the cash is again a real thing. Debit what comes in, credit what goes out. So cash is going out of the business, 3,18,000. So you should be crediting the cash, right, by 318,000. So this helps us to complete the composite entry in hand by applying debit and credit rule. The same thing now can be actually used or actually understood with the help of normal balance rule. The normal balance for assets and expenses is debit. The normal balance for liabilities, capital and revenue is credit. This is what we already know. I discussed in the last lecture. Okay, so I would say if you apply the same normal balance rule, the car is coming in. Car is an asset. An asset is going up. To record the increase, normal balance means to record the increase, it should be debited. So normal balance of asset is debit. So since it is increasing by 4 lakhs, we should be debiting it. On the contrary, my another asset is going down as well by 82,000. So my old car 82,000 should be credited. to record a decrease in my equipment or my asset. And my cash is again an asset. To record a decrease, I should be crediting it. So this is how a normal balance rule would apply. Okay, so either you use the debit and credit rule or you use normal balance rule. The end effect would be same. Your actual composite entry would remain the same under both the methods. Okay, let's move further and take up some more example in front of you. The example here says cash received from Rohan rupees 6,000 and allowed him a discount of 400. So I am not going to show you the solution for this particular example. I wish you should apply the discussion we had so far, because this is the last slide for the purpose of this rule of this compound entry. So I would want you to just think what will happen. I will discuss, of course. See, cash has been received from Rohan 6,000 and allowed him a discount of 400. So it means Rohan was supposed to pay you, right? He was supposed to pay you 6,400. That's how you received actually 600. So cash is coming in. So debit what comes in, right? Cash is a real thing, and real account rule says debit what comes in. So you debit cash. And credit what goes out. Your Rohan was a liability, so debit the receiver and credit the giver. So giver is Rohan. Rohan is a personal account, right? So cash 6,000 would be debited and Rohan would be credited. But for how much? He was supposed to give you 6,400. So Rohan will not be credited for 6,000. Rather, he would be credited for 6,400 because the actual liability due from him, or actual amount, he was basically our debtor. So the actual amount of asset to be received was 64. So 64 Rohan would be credited. What is the difference? The 400, the discount allowed is an expense for the business. It's a loss for the business. So expenses and losses have debit balance, right? So 400 would be debited. So 6,000 cash debited, discount 400 debited, and Rohan credited. This is how you solve, questions. It was purposefully not shown as a solution to you so that you could have an idea. You could use your brain and try to understand that how do we actually apply this rule of compound entry. This is a compound entry where we have two parts debited and one part Rohan being credited. So I hope you noted down the other example so that you could practice later. I would like to wind up now by concluding that the term compound and composite entry, they both are same, and anything can be debited, anything can be credited. There could be more than one debit or there could be more than one credit, but this is for sure that we have to have at least two debit or at least two credit. If it is only one debit and one credit, then it is not a composite entry, right? Thank you very much for watching this concept of generalizing.
With this note, thank you, ma'am. Thank you so very much for explaining us in detail the concept of journalizing. Dear friends, please be with us as we are back after a short break and we would be discussing more. Hello friends, welcome back to this session where we are discussing on journalizing. In our previous session, we discussed on composite entry, whereas in this half, we are going to cover opening entry as well as a closing entry. And for this discussion on the topics, we have with us in our studios Dr. Amarjeet Kaur. Friends, if you want to ask questions on today's topic from Dr. Amarjeet Kaur, then do call us through our toll-free number. Our number is 1800-110-430. Now, I would like to request Dr. Amarjeet Kaur to carry the lecture forward and explain us in detail about the opening entry and closing entry.
Sure, Gitika. Thank you very much. Welcome back. As Gitika introduced, we are going to continue discussion on opening and closing entries. So before we talk about or we practice about opening and closing entries, let's understand what opening entries are. I will keep the closing entries at the end, discussion for closing entry at the end. So what are opening entries? To understand opening journal entries, it's very, very important for you to learn that as a law requirement, as a legal requirement, businesses are supposed to close their books of account every financial year so that they could calculate their tax liability, and also they could find out profit or loss for the operations of any particular year. So it's kind of mandatory for a business to close books of account in 1 year, and that happens on the last day of one accounting year, and then in the next accounting year, first day, we begin with opening entry, right? So opening, I would request the cameraman not to put the focus on the slide, please. We would like to discuss for a while. So I'm saying the opening entry is made on the first day of a new accounting year. It may happen when a new financial year is beginning. Either a new operating cycle is beginning. So a new financial year, new operating year is beginning. A business would record an opening entry in its books of account. So what all would be there in an opening entry? That is the question. And why do we call it as an opening entry? So let's answer the second question first. The second question is, why do we make this opening entry? We assume business is a going concern. Under the going concern concept, we are assuming business is going to last for long, and we do not see the liquidation of the business in future. So this is the background in mind. This is an assumption in mind. So since we are assuming the business will keep on going, we need to halt in between the life of the business, which is infinite as per our assumption, and to find out profit or loss of the operations of the business we carried during a financial year or during one operating cycle, as whatever is convenient or required. So we need to stop to find out profit or loss, which we do by making our income statement. This profit and loss is transferred to balance sheet, and then the balance sheet is closed on the last day of one financial year, so as a part of financial statement, and then we have account balances shown in the balance sheet, which is an important financial statement. So we would have couple of account balances of different accounts pertaining to assets, liability, capital, not of revenue and expenses. I will restate: pertaining to assets, liabilities and capital in our balance sheet, which we are closing on the last day of the financial year, and those balances would be carried forward to the next year, which is a new financial year, a new operating cycle to you. Okay, so we would have all those balances carried down from the previous year to the new year. So those balances which have been carried from the previous year to this year would be recorded again for the first time in our books of account of new year under the head opening entry. Right? I hope you could understand what is opening entry. Opening entry means recording assets, liabilities, capital, etc. on the first day of new financial year or of new operating cycle, whatever we are following. Now, what do we do? Which rule we follow to record an opening entry? That is the second question. Once we understood what opening entry is, the second thing is which is the rule? What is the rule? Which particular rule of debit and credit is applied? The rule is very much linked to the normal balance rule. All assets would have normal balance as debit, right? This is what we know by the normal balance rule. All liabilities would have normal balance as credit. This is what we know. And capital would also have credit balance as a normal balance rule. So it means all the assets which are given in the example or which are there in the balance sheet, all the assets, whatever the name of the asset, you need to be sure about that this item pertains to asset or liability. This is an essential requirement for you. So all the assets would be debited. Either this is cash or it is an equipment or machinery or land or debtors or any other asset, right? Current or fixed, irrespective, they all would be debited. And liabilities, whether it is creditors, bills payables, notes payable, accounts payable, anything, right? Or capital, which is payable, preference or equity, they all would be credited. And this is how we record the opening entry in our books of account. So we do it for the first time, first day. This is what is actually basically recording the balances of the balance sheet of previous year. This is how I would put it in simple words. Okay. Now we will take some example and we'll practice question on opening entry. So let's take this example which says, on the first day of new accounting year, Anirudh has capital of 1,80,000, debtors 40,000, stock 5,000, cash in hand 2,000, cash at bank 5,000, we have furniture 6,000, we have creditors 12,000 and we have machinery 1,30,000. So I would want you to kindly note down these values. It will help you to understand opening entry easily, which I am going to show you in the form of solution on the next slide, but it will be better to note down these values. So it means Anirudh is the owner of the business, right? And these are the opening values, opening balances for him on the first day of new accounting year. So this is important. It doesn't say, the question doesn't say that you have to record an opening in an opening entry. The question just says, on the first day of new accounting year, this is what it is, and pass and generalize it. So it means when we have more than one items given on the first day of the new accounting year, it certainly qualifies to be recorded under the opening entry head. So it is essential that you actually learn under what condition you will call it as an entry as opening entry. It's simple. If the balances are given on the first day of new accounting year, it certainly calls as an opening entry. Okay. So now look at the solution part. I hope you noted down the values. So if you look at the solution, we are debiting debtors. Why? Because debtors were given for 40,000 and they are assets, right? So assets, as I said, as a rule, of opening entry, what to be debited, what to be credited, as a rule is this, that debit all assets and credit all liabilities. This is what I said. Okay, so debtors of 40,000 being given in the question would be debited. Stock being an asset, 5,000 is given in the question, would be debited. Cash in hand is given for 2000 and cash is an asset, need not to say, would be debited. Cash at bank, it is a bank balance and again an asset, would be debited. Furniture 6000 is given, would be debited. Machinery again is a very important asset, it's a long term asset and it would be debited 1,30,000. And then look at the cursor I am indicating, goodwill. Leave it for a while. We will just come back after a minute to this value. So this is not given in the question, by the way, right? So I have debited all the items given from debtors to machinery up to 1,30,000. So what I have credited is capital, which is given, very much given in the question, 1,80,000, and creditors again are liabilities. So capital and liabilities would be credited, the normal balance is credit, so 12,000. So what is the total coming out in the credit side? 1,80,000 and 12,000. It means the total of the credit side is 192. And if you debit all the items given in the question from debtors to machinery, it would be 1,88,000. So if you note down the values and if you calculate, if you sum them up together, the summation is coming out 1,88,000. So the difference of 192, here the credit value is 192, 180 plus 12. So 192 minus the total 188, the difference is the 4,000 and that is what is the value of goodwill. So this is known as calculating or finding out balancing figure. So this is the goodwill which is generated. So the opening values given for assets, opening value given for liabilities make a difference. If your credit value is more than the debit value, this would be goodwill. If your debit value is more than the credit values or liabilities, this would be capital as a balancing figure, right? So we can actually, so the point I am trying to make out is that we can actually calculate capital or goodwill, whatever is applicable or as per the given data in the question, with the help of opening entry if not given. If you have been given capital value and opening entry as well as your goodwill, then possibilities the values would match. And there's a possibility that there's no goodwill because we do not record the goodwill unless we purchase it, right? So goodwill, there's a possibility there's no goodwill and even then your both side match. If both debit and credit side are matching, there's no worries at all. But if they do not, the difference would be either goodwill and that would be when your credit side is higher as it was there in this case. In the example we took, our credit side was 1,92,000. Our total of debit side was 1,88,000. So difference of 4,000 was recorded under the goodwill head and which was actually the balancing figure, right? And the same thing can happen, if our debit side is higher, again we would have a balancing figure, but in that case the balancing figure would be capital, would be recorded on the credit side if the debit side in total of the given item is higher than the credit side, right? We will take example of this value of debit side being higher as well. Okay, so I hope you could understand opening entry. Let's take one more example to practice opening entry. This says, on the first day of new accounting year, Ashok has debtors of 6,000, stock of 4,000, cash in hand of 2,000, plant 5,000, land and building 10,000 and creditors 10,000. So the beginning point for you should be to understand which item or out of given items, which item is debit, an asset item and which item is a liability or capital item. So that should be your first step in solving any question. So debtors are certainly the people who have to pay us. So that is an asset. Certainly stock is an asset for sure. A current asset, inventory or stock is one and the same thing. Cash in hand, again a very important example of asset. So a liquid asset. Plant is another asset given in the question, and land and building is also an asset. Creditors are liability. The only liability which is given is creditor. So rest of the items they all are assets. The only liability given is creditor, and which is 10,000, right? So let's try to put it in the solution now. So debits would be for all assets. So debtors are given 6,000 will be debited. Stock asset would be debited 4,000. Cash in hand, again another asset, 2,000 would be debited. Plant, another asset, 5,000 would be debited. Land and building, another asset, long-term asset would be debited. So only one item given was creditors in the credit side, and the value was 10,000. So if you make a total of debit side, 10 plus 5, 15 plus 2, 17 plus 4, 21 plus 6. So coming out to be 27. So it means the total of my debit value is 27, whereas total of my credit side of the given item is 10,000. The difference is 17,000, and that would be capital under balancing figure. So this is as a matter of practice that the balance figure would be taken as capital if the debit sides are higher. So this was exactly the opposite of the previous example. In the previous example, the balancing figure was goodwill. Why? Because your credit side was higher. In this example, my debit side was higher, and the difference would be taken to your capital. Debit side was higher than the credit side. Debit side was 27,000, whereas the value of the given item in credit side was 10,000. So the difference of 17,000 would be credited to capital under the balancing figurehead, right? So this is how we solve the problems of opening entry. Now let's talk about closing entries. So what are closing entries, and how do we pursue them? Closing entry is just opposite of the opening entry. Opening entries are passed or recorded on the first day of accounting year, whereas closing entries are recorded on the last day of the current accounting year to close our books of account. So what happens, the closing entries are basically, they pertain to those items which are not carried in the balance sheet to the next year. What does it mean? It means, if you remember the discussion we had in the last lecture number 7 in Generalizing Basic Journal Entries, we discussed about types of accounts. We talked about real accounts, we talked about personal accounts, and we talked about nominal accounts. So real accounts are real things which would be carried in the balance sheet to the next year. Personal accounts are also the real things, either they are debtors or they are creditors, and they are carried to the next year in the form of debtors or creditors. But if we have nominal accounts in our books, which generally would be there for sure, revenue and expenses, two important examples under nominal accounts, right? So they would be there until the last day, but are not going to be carried to the next year through balance sheet. It means balance sheet would have only either your assets, liabilities in the form of real as well as personal account, and capital, again a representative personal account, but it will not have nominal accounts like expenses, like revenues. So they would be closed. So all account items which belongs to or which fall under nominal account category, they would be closed, and their end balance would be transferred to the balance sheet. Okay, so for example, profit and loss account or income statement. This closing of accounts would be applicable, first of all the items pertaining to trading account and profit and loss account. Thereafter, this closing account, the closing entry would be passed to close the trading account as well as profit and loss account and to transfer it to the balance sheet. Okay, so it means closing of all the nominal accounts is been made through closing entry in our books of account on the last day of the accounting period. This is what it is. So this is what the closing entries are. Now, what are the rules for closing, passing a closing entry? So rule is very simple, but gradually it becomes little complex when we go further to close trading and profit and loss account. To begin with, the basic rule of closing entry, passing a closing entry is this: the account which have debit balance or which has debit balance should be credited, right? And the accounts which have credit balance should be debited. This is a very simple rule. So it means you have to do the inverse, but there becomes something very, very imperative here. What is imperative? The imperative thing is this: you should be knowing the actual or the normal balance of that account. Unless you know the normal balance of a particular account, then you cannot actually do the inverse. So that's why I've been emphasizing we should be knowing that all assets would have normal balance as debit. All liabilities would have normal balance as credit. All capital would have normal balance as credit. All revenues would have normal balance as credit. All expenses would have normal balance as debit. So first of all, it's important to be sure about normal balance, and then only you can think of inversing it or reversing it. Alright. So if the salaries have normal balance of debit, so to close the salaries account, they would be credited and the salaries account would be transferred to either either to P&L account or income statement, whatever you may say, right? So it means we have to do the inverse of the normal balance rule to close accounts. So this is the principle for closing entries. Let's have a look at few examples here which will help you to understand how the closing entries are passed in trading and profit and loss account. So let's have a look at the slide here. It says closing a trading account. So when we have to close a trading account, the trading account itself would be debited and the items which were there on the debit side would be now credited. The stock, which was the opening stock, would be credited. If you remember, if you have any idea, while we make a trading account, the opening stock comes on the debit side, purchases comes on the debit side, sales returns comes on the debit side, cartage, etc. come on the debit side. So all those items, as I'm saying, have been actually debited would be now credited. The accounts having debit balance would be credited now. So that's why the trading account has been debited and the stock, purchases, sales returns, etc. have been credited. Alright. On the other hand, sales account has been debited, purchase return has been debited, and stock as a closing balance has been debited, and trading account has been credited. So this is how we would be passing certain entries to record them in the trading account. So under trading account, this is how. So when we have to close the trading account, the balance of the trading account could be either the credit side could be higher if we have a gross profit, or the debit side could be higher if we have gross loss, right? So if we have gross profit means my revenue side, my sales side was higher, that is my credit side was higher. So revenues have a credit balance. So in that case, I would be debiting my trading account and I would be crediting my profit and loss account, because from trading and loss account we transfer the value to income statement or profit and loss account. Though after the schedule 3 being introduced, the latest thing for companies especially, not for, because that those rules are applicable for listed companies and for other companies, a couple of other companies as well, but not for individual proprietors, etc. So we have both the rules actually existing. Okay, so in that case the profit and loss account still remains the title, but for companies, statement of profit and loss becomes the new title for all listed companies and unlisted companies with certain cap on capital. So this is how it is. Okay, so what happens, to close the income statement? So here are certain examples in front of you. If you look at the slide, it says income statement debited, and salaries account has been credited, rent account has been credited, commission account has been credited, advertisement has been credited, bad debts credited, and discount credited. Why? All the examples here given in the credit side, they all are actually expenses. Salaries, rent, commission paid, advertisement paid, bad debts incurred, discount paid or allowed. Okay, so all expenses have normal balance as debit, I will repeat, and to close them, as I said, as a rule, we should be crediting them. That's why I credited them. And where do we transfer them? We transfer them to income statement. So that's how the income statement has been debited with all items of expenses pertaining to office and general administration. And this is how it will happen to the credit side of the income statement. So whatever we credit, so actually whatever has been credited for example, revenues. So revenues are having normal balance of, I hope you remember, credit, and they should be debited. So to close it, so that's how it happens. That's how it happens. Okay, so this is how we would do. Let's say interest received, dividend received, or discount received, discount being given to us, they all would be now debited because they all are actually having credit balance as a normal balance. To close those accounts which pertain to these nominal accounts, either this is discount or interest received or dividend received, we would be crediting them, we would be debiting them, right? Opposite of credit, because they were actually having their normal balance as credit. And to close them, we would be debiting them, and then we would be transferring it to the income statement. That's how you would see these items on the credit side of income statement. Okay, so this is what is closing entry. I hope you were able to gather the discussion. So if you have any question, you are most welcome to raise it. Thank you.
With this note, thank you, ma'am. Thank you so very much for the productive session once again. And friends, if you want to give your feedback or if you want to ask any question, then do write to us at info.cec@nic.in. We will be meeting you very soon and would be discussing more. Till then, take care. Goodbye. Thank you, ma'am. Thank you once again.
Thank you, Gitika. Thank you, viewers.